Welcome to Bond Street, and in the series we have a very special guest joining in today. It's Mr. Ashish Chauhan, MD and CEO at NSE. Mr. Chauhan, hi, thank you so much for joining in. And when we talk about the bond markets, we do realize that the last 10 years perhaps did not yield much in sense of volumes or participation therein. But 2025 has been a great year. And is that a building block for the next few years now, would you say?
I broadly agree with your observation. Why? Because when Mr. Modi took over in 2014, India's equity market capitalization was 67 lakh crore. Today it has gone to 475 lakh crore, right? And so it has gone up 7 times.
Right.
The bond market has remained where it was, which is probably 15-16% of the total GDP, whereas the equities market has gone to 140% of the GDP. And that's where basically we have seen that sort of divergence between equities and bonds emerging. But there have been also underlying reasons why the bonds market or the debt market in India has not developed. And for me, that includes the overall debt to GDP ratio. I mean, if you take a look at the debt to GDP ratio of US, it is more than 4.5, 5:1. China is also 4:1, 5:1. India is running with all the bonds and all the loans put together on the total economy at some 0.6, 0.7:1. So we are like literally 5-6 times lower than what we should have given the size of economy.
Right.
And so if you want to grow fast, you will have to use debt very well. You don't have to sort of balloon it up in an unproductive way, which was the concern during 2012-13. But today we have actually sort of shrunk the bond market, which itself is unhealthy in my opinion.
Right. So when we have this vision of Viksit Bharat, and almost all segments and sectors seem to be working towards that, and when you have a developing nation, you need long-term capital stability therein. Would you say that the bonds will play a very important role therein?
Each economy, I mean, if you look at the last 1,000 years, the city-states, the cities, the development of every economy, including the last 40 years of China's growth, has been on the back of debt. And that is what we need to understand, that the long-term debt is absolutely essential for any economy's growth. And no economy can build infrastructure basis equities. Equities are inherently risky, and they are what we call quarter se quarter tak. And that's where you don't sort of invest for 30 years, 40 years. Whereas the pension funds, which have long-term liabilities, the insurance companies, and many other similar entities, trusts, they require continual income flow, and that's where private equity guys, and that's where we need to promote such institutions to invest and make life easier for them, because we have now a plethora of regulators. Each of them have their own very tight regulations, and they inherently ensure that the bond market, which is actually where they are supposed to get their returns from, ends up not developing that well. And that's where I think a lot of coordination amongst the regulators is required. Otherwise, ball is like falling between all these regulators.
Right. In the last 2 or 3 years, as you've been telling us as well, that NSE volumes in bonds has increased, especially in 2025. What is it that NSE plans to do from here on, and what policy support are you then looking for that?
In a way, of course, the tax policies, if they become favorable to bonds, then that becomes easy. Last 10, 11 years, we have seen much more tightening on the bond side, on the taxation side. But effectively, what we have seen is that the OBBB platform, which SEBI mandated recently in 22, we started working on it. And then in 22, we had per bond around 100 transactions a year. Today, we have reached 1,066 transactions a year in 25, still a few days to go.
Right.
And so, in a way, we have gone up like 11 times more transactions in 3 years. But if you look at the aggregate number or absolute number, in this year, we have done around 10 lakh transactions, which is like a minuscule compared to what we do in equities, right? I mean, it's not even a...
Baby steps, but you're getting there, would you say?
Even a fraction of a fraction. For me, things happen slowly and then suddenly. This is the slow part. Suddenly, somewhere things will happen. For me, OBB platforms have been great boon for investors to come into the markets and taste the bond markets directly. And then, of course, we have also applied We are currently around 29 OBP platforms. Probably more will come. Okay. They will go out. We need to do market making through OBP platforms or otherwise for investors to get that small little lot liquidity when they want to come out, because liquidity is an absolutely essential function of a well-functioning market, and that's where we have not yet been able to provide that low amount of or small amount of market making, which has been a boon in SME market. If you look at SME equities, have come up very well due to the market making being made compulsory by SEBI. But in the bonds, we have not yet seen that. Hopefully, SEBI will do it in 26. And then, of course, more and more companies are raising money abroad, but for their infrastructure stuff. But when India has to do much more infrastructure, if we are able to rationalize policies on bonds across all the regulators, like PFRDA, NPS, and of course insurance, RBI, SEBI, then probably we'll have a very well-functioning, less risky, because bonds are inherently less risky assets compared to equities, and they will give consistent returns to the investors, which is absolutely an essential part, especially for the graying economy. We have a silver economy. We are a young economy today, but we have an equally large or even more interesting number of people who are becoming old. They will require consistent income going forward, and that's where we need to build that. Lastly, we have also applied for corporate bond index futures and government bond index futures and options to SEBI, so that if those sort of approvals come, then you can create a tertiary liquidity basis which the secondary liquidity come in. The primary market on bonds, we have done very well. We are raising CPs and bonds and InvITs and REITs to the extent of almost $220 to $250 billion a year on NSE alone. And so that's a very large number. But then there is no trading, right? So that's where people hold to maturity, and we need some trading happening.
Mr. Chauhan, as always, thank you so much for joining in. Really appreciate your time here with us at CNBC-TV18. And with that, that's all the time that we have on Bond Street. Thank you for watching.
CNBC-TV18 and India Bonds presents Bond Street.